Alright, so if you still remember, we started our journey, right? It's quite some time already. From the first chapter, I've introduced to you the important core topics, which is first one is investment, second one is financing, and the third core topic would be dividend policy. Alright, so all these chapters we have completed. We have done many chapters on investment and many chapters on financing. So now today we're going to be learning the third core topic, which is dividend policy. So what are the subtopics or important points that we're learning under dividend policy would be investors' preference on dividends. Alright, what do they like when it comes to dividends? What is signaling effect? What is residual dividend model? What is dividend reinvestment plans, stock repurchase, stock dividends, and stock splits? Alright, so let's begin with understanding what is dividend policy all about. Alright, the decision to pay out earnings versus retaining and reinvesting them. So that is dividend policy. Alright, so every year, end of the year, when company make profit, so they have to make a decision. How are they going to use the profit? Are they going to pay out their profit, their earnings as dividends, giving back to the shareholders, or to retain the profit? Alright, to retain the profit so that they can reinvest. Alright, they can reinvest in another project or to expand their business. What is their choice? Alright, so that is the dividend policy all about. So the management of the company, they have to make a choice. They have to make a decision how they're going to distribute the profit. Alright, whether they keep 50% as retained earnings, another 50% as dividend, or some companies they don't want to pay out dividend at all, and they keep all their profit as retained earnings. So what is their choice? And we're going to be learning some of the theories behind and how company make such policies. So dividend policy would include high or low dividend payout. Alright, are you going to pay high dividend payout, or are you prefer to pay low dividend payout? Then what about stable? Alright, if each year you're paying around the same dividends, alright, from profit, doesn't matter you're having a higher profit or lower profit, you're basically, let's say for $1 you're paying 20 cents dividend. Alright, so that's stable. Irregular means when the profit is high you pay high dividend, then the profit is low you pay low dividend, so that's irregular. And then how frequent to pay dividends. Right? Some companies, if you look at the financial institutions, right, the banks, they usually pay dividend twice a year. Alright, so most of the companies they pay per annum once a year. So how frequent you want to pay the dividends, and are you planning to announce a policy? Okay, if you announce a policy, that means the market going to take it. Alright, they're going to use that statement since you already announced, and if you did not do as you announced, then it's going to be a problem. Alright, so some companies feel that better I don't announce, and when I want to pay high dividend I just pay. Alright, if I announce that the company is having a high dividend payout policy, then if you never met your promise, then it's going to be disappointment to the shareholders that can give negative repercussions. Alright, so let's move on. Alright, so we are starting with the first theory itself. It's called dividend irrelevance theory. Alright, as the theory, the name itself, irrelevance, dividend irrelevance. It means giving dividend and to have a dividend policy itself, it's not relevant. Okay, let's go in detail. Investors are indifferent between dividends and retention generated capital gains. Alright, so this type of investors, alright, they do not care whether they get dividends or you don't give dividend and retain it, and the company's share price to increase. That's capital gain. Alright, so they don't care whether you pay dividend or the company retain all the profit. So that the company expands and the share price to increase. So investors can create their own dividend policy. So that is what we're trying to say. A company do not need to have a specific dividend policy. Why? Investors, if they want cash, they can sell their shares. Okay, doesn't mean they're going to sell all their shares. Maybe they sell 5% of their shares. Alright, if they need cash, they can sell their shares. If they don't want cash, they can use the dividends to buy back the stock. It means when the company pay dividend, they can use the money and buy more shares from the company. So this way, the investors are creating their own dividend policy. Right? So since the investors can create their own dividend policy, they don't want the company to have a specific dividend policy. Alright, so that is the dividend irrelevance theory all about. So this is proposed by M&M, Modigliani and Miller and based on unrealistic assumptions. See, M&M always known for their unrealistic assumptions, which is no taxes and brokerage costs. So hence this theory may not be true, because if you have an assumption that you don't pay tax, you don't pay brokerage costs, in reality it doesn't happen, right? Because if you want to buy shares, you have to pay brokerage costs, and when you receive dividend, you have to pay tax. Alright, so this is the for empirical test. Right, so let's move on to the next theory. Why investors might prefer dividends. Alright, so this theory is known as bird in the hand theory. Alright, bird in the hand theory. It's coming from the saying that bird in the hand is more valuable than two birds in the bush. Alright, so what do they mean? May think dividends are less risky than the potential future gains. So these investors, they prefer to get high dividend payout, and the reason is every year, alright, getting dividend, it's more certain compared to uncertain future capital gain. Okay, so let's look into capital gains. So class, do you still remember how a company or how the shareholders get the capital gain? See, for example, if you buy a share for 2 ringgit today, and after 5 years, let's say the share price increased to 10 ringgit. How much is the capital gain? 10 minus 2, your capital gain is 8. Alright, so when your share price increase, alright, you're buying at a low price, selling at a higher price, the difference is your capital gain. And usually capital gains will not happen immediately. You don't buy share today for 2 ringgit and after 6 months it increased to 10 ringgit. Alright, so it doesn't happen quite often, right? So if you want to receive capital gain, you have to wait. Usually it's long term. It takes 5 years, it takes 10 years. So what these investors under this bird in the hand theory, what do they feel? 5 years, 10 years, there's a lot of uncertainties. Alright, maybe that time there will be a crisis, maybe that time the company might no longer be profitable as now. So I don't want to focus too much on the capital gain. Alright, depend too much on the capital gain. I rather depend on the dividends, which I think is more certain, because every year when the company made profit, they can pay dividend. Alright, so investors would value high payout firms, alright, more highly compared to the low payout. Alright, so high payout will result with a high share price. So those companies who pay high dividends, you can see the share price will be higher, and these investors will particularly choose those companies that pay high dividend. Alright, so let's move on to the next. Alright, the next theory, alright, would be investors who prefer capital gains. Alright, just now the first one is dividend irrelevant theory. The second is bird in the hand theory, who prefers dividend. This is where investors would prefer capital gains. Alright, the reason is they want to avoid transaction costs. Right, let's say you receive dividend, you use the cash to buy more shares, then you have to end up pay brokerage fees, taxes. Alright, so here the investors who prefer don't give dividend. Alright, I'd rather wait, but in next 2 years or 5 years or 10 years, when the share price increase, I'd rather receive the capital. Okay, so maximum tax rate is the same as on dividends, but taxes on dividends are due in the year they are received, while taxes on capital gains are due whenever the stock is sold. You see, every year when the company pay dividend, you have to pay tax, but when the only time you pay tax for capital gains would be when you sell the company's shares. Alright, capital gain is when you buy at a low price and you sell at a higher price. After 5 years, if you do that, then you pay tax. After 10 years, you sell your shares, then you pay tax. It doesn't happen in between, or doesn't happen every year like dividends. Alright, if an investor holds a stock until his or death, the beneficiary can use the date of death as the cost basis and escape all previously accrued capital gains. See, if like your grandfather bought a share 40 years back for $1. Alright, after 40 years, maybe it's 100 ringgit now. Alright, so what is the capital gain? You bought it $1 and you sell it 100 ringgit. Your capital gain is 99 and you need to pay tax for the 99, right? But let's say after 40 years, when your grandfather is no longer alive, but he passed the shares to you, alright, as a beneficiary. And how much do you pay the capital gain? Basically none, nil, right? Because your capital gain starts at the time when you receive the beneficiary. It means when the time you receive your stock, it's already worth 100 ringgit. So only after the share price increase more than 100 ringgit, the difference you pay tax. You don't pay tax from the time your grandfather bought the share. Alright, so that is a benefit of having capital gain as well. Alright, so let's move on. So what's the information content on signaling and hypothesis about that? Investors view dividend increases as signals of management view of the future. Since managers hate to cut dividends, they won't raise dividends unless they think the raise is sustainable. Alright, so class, how the market will react when a company increases the dividend payout. The market will view that the company must be performing well, or the company has good prospect in the future. Because if you increase your dividend once, you would not want to cut the dividends the following year, because that kind of gives a negative outlook in the market. So if the company increase dividend, market assume that they can sustain the increase. Alright, It means the company must be doing well. However, a stock price increase at the time of the dividend increase could reflect higher expectation for future earning per share, not a desire for dividends. Alright, so in this case, stock price increase at the time will give you an expectation for higher earning per share. So in these circumstances, you might not desire to get the dividends. Alright, the next would be clientele effect. Different group of investors or clienteles prefer different dividend policy. Alright, so clientele effect means what is the expectation of investors towards dividends. Alright, so there are investors who prefer to get dividend, like I said, the high dividend payout. Some investors who prefer not to get dividend but to get capital gain. Alright, so different groups of investors prefer different dividend policies. So how they decide based on the company's past dividend policy. Alright, if a company is giving the dividend payout every year without fail, alright, then you can expect that the shareholders prefer to have high dividend payout. Alright, so looking at the past track record of the company, you can decide what kind of clientele effects or what kind of investors the company has. Clientele effects impede changing dividend policy. Impede means prevents. Alright. Taxes and brokerage costs hurt investors who have to switch companies. See, if let's say for example, investors who like high dividend payout. So let's say they're investing in companies like public bank, where you usually get dividends without fail every year, sometimes twice a year. So let's say the company stop paying dividends. What will happen? If company all of a sudden stop paying dividends, then the shareholder might sell off the shares and find another company that pays high dividend payout. So if they do that, if they switch companies, they have to pay taxes. If there's capital gain, then there's going to be brokerage costs and they're going to buy new shares. So investors do not like to switch companies. Alright, so the clientele effects say that the company should not change the dividend policy, because the investors who already invested in the company, they don't want you to change their policy. Alright, they don't want to go through all this additional costs. Okay. Residual dividend model. Okay, let's talk about the next type of dividend. It's called residual dividend model. As you see, the word residual means the remaining or the balance. Alright, find the retained earnings needed for the capital budget, pay out any leftover earnings as dividends, and this policy minimizes the flotation and equity signaling costs, hence minimizes the overall cost of capital. Alright, so let's see how this works. When a company, let's say the 2019 profit is 100 million, right? From 100 million, you have already pre-planned that you need 80 million for a new project, right? End of 2019, the profit is 100 million, and the following year, you already have a project worth 80 million. So what would you do? From the 100 million, you keep 80 million as retained earnings for your future project as the capital budget. The remaining 20 million you pay out as dividends, right? So this is called residual dividend model. So whatever you need for the new projects, new capital budget, you keep the profit as retained earnings. Anything the remaining you pay out as dividends. So this policy minimizes flotation and equity signaling costs. It means, let's say you never planned. From the 100 million, let's say you pay out 50 million as dividends, and the next year you found out that you need 80 million for the project. So what do? You only have 50 million left as retained earnings. Then you need to again issue new shares worth 30 millions. And what happened every time you issue new shares, there going to be flotation costs. You need to pay to the investment bank, to the legal, alright, the legal costs and equity signaling costs. We'll be learning about this later. All that will end up increase your cost of capital. So to avoid all that, you better pre-plan earlier, so that you can keep what is necessary as retained earnings, remaining only you pay out as dividend.